Okay, let's keep responding to comments. Tampa Retrograde 8951 has a great question. He says, Logan, I'm almost 64 years old. Is infinite banking still a viable option to me? Great question. My question back to you is, are you still using a bank account? If you're still using a bank account and you're still engaged in the banking function, then yes, I think it makes sense for you to try to reclaim control of the banking function in your life. What might change is the potential solutions that we're looking. So if you're 64 years old and you're still very healthy, taking out a whole life policy on yourself might make sense. If you're not healthy at age 64, we could look at other options. We can look at taking out policies on children or grandchildren or business partners. Okay. But the short answer is we would look at it. I would say you're never too old to reclaim control of the banking function in your life. But the solution that we use might change depending on your age. So if you're young and healthy, it's pretty much a no-brainer to start with a policy on yourself, right? That's pretty much always the place to start. If you're not young and healthy, then we may actually take out a policy on somebody else. It just kind of depends. I've definitely put very good policies on people in their late 50s. I definitely think in your 60s, a policy on yourself can make a lot of sense if you're still healthy. We can look at it. And of course, this gets into case design. If you're in your 70s, then I would say a policy on yourself may still make sense, but it's going to be more death benefit and legacy oriented. There will still be cash value, which you can still use. And depending on how healthy you are, if you're in your 70s, you might live another 20, 30 years. Just depends, which is plenty of time for that policy to get going. But I would say there's going to be more emphasis then on the death benefit, which makes sense because for people in their 70s, they place more value on the death benefit, on the legacy component, on potentially the long term care protection that's included, that kind of a thing. So I would say taking out a policy on yourself in your 70s still makes sense if you place a value on the legacy component of it, right? And on the other components, not just the cash value. Okay. So yeah, I would say infinite banking is still a viable option for you. It just becomes a question of what's the best solution. It may be a policy on yourself, it may be a policy on someone else. But the long and short answer is we can take a look at it. And I'm sure we can find a way to improve your financial efficiency, right? The more I go in this business, the more, yes, the infinite banking concept is my specialty, my area of focus, but I'm really trying to help everyone improve their financial efficiency as much as possible, which means I'm focused on real concrete results, not hypothetical future results. It's not put your money in this investment vehicle and hope you get some kind of return. No, it's more about let's look at what you're doing right now. Let's look at your cash flow situations today, and I can find ways to optimize it by, refinancing your debts, by, optimizing your different insurance coverages, replacing health insurance with health sharing, getting you a different health insurance policy, looking at your car and auto insurance, your car insurance, whatever, right? Whatever it might be. So I help people with financial efficiency and then I help be there to provide accountability and coaching as we execute on these plans. So I definitely have clients who decide that for whatever reason, the infinite banking concept is not for them, but I can still help them in various ways. Maybe we're just talking about more generic life insurance. Maybe we're talking about health insurance. Maybe we're talking about a first lien HELOC and velocity banking. Maybe we're talking about long term care protection. It could be a number of different things. But it's a great question. Thank you for your comment, Tampa Bay Retrograde. Hedge Fund 996 says good educational content. Thank you for the kind words. Appreciate it. Richard Sailing says, powerful video, Logan. Thanks for getting this info out there. Thanks for your comment, Richard. I appreciate it. And then MDA 0214 says, don't be stupid. This is the dumbest idea ever. Well, thanks for your comment, MDA. I appreciate it. I think that comment kind of speaks for itself. This is the sort of objections that we get. So if you have a substantive objection, you'd like to have a discussion, maybe even a debate on the merits or demerits of the infinite banking concept as you see them, we can have that discussion. This is on my infinite banking versus conventional banking video. But thanks for the comments, Richard and MDA. Heminal for Life 849 says, great video. Thanks for the comment. I appreciate it. Nelson Advisors says, thank you for the interview. Thanks for commenting, Peter Nelson. I appreciate it. This was Peter Nelson's interview. So, one of the things Peter Nelson has become known for in the business is doing business with fraternal organizations. So, a lot of the business that we're doing with insurance companies, you can also do with fraternal organizations, and there can be various reasons for doing that. Sometimes the fraternal organizations can do things that the insurance companies cannot do because they're not insurance companies. They're technically 501(c)(8) nonprofit organizations, which means they're not regulated the same way as the insurance companies. And so sometimes they're able to do some pretty unique things that can be helpful for your clients. The other thing, too, is that when you actually do business with them, you're actually joining a fraternal organization. So you're actually a member of their organization, right? So it creates a different sort of relationship. And Peter kind of educated us a bit on that. One of the fraternals that Peter works with quite a lot, I also work with, is the Catholic Order of Foresters. Peter comments again, says, I absolutely love this video. And thank you, Logan, for the mention. I'm looking forward to continuing the financial malpractice series. Thanks, Peter. Appreciate it. This was on our interview with Chris Kirkpatrick. And then Peter commented again, said, great stuff. Thanks, Peter. Appreciate it. This was on our partnering as one of the sort of corollaries that came out of our financial malpractice series is the idea of partnering, right? I partner quite a lot, actually. I do, as an example, health insurance. I'm not the expert on health insurance, though. I have my health insurance license, but that's where I'll bring in Brad Owens, who does health insurance. And, we've helped clients save money on health insurance. Disability insurance. I've gotten disability insurance policies, critical illness insurance policies, long-term care insurance policies for my clients when and where it makes sense. And for each of those, I'm partnering with someone on the back end to help because I cannot be an expert in everything. So Ben Feigenbaum helps me on the disability side. He's been doing only disability income insurance for 38 years, right? It would be ridiculous for me to do that on my own when I can just partner with Ben and I can have my focus area where I go deep, which is the infinite banking concept and specially designed whole life insurance policies. So that's very important. When you, instead of having the abundance mindset, when you instead have the scarcity mindset and you behave the way some financial professionals do, like this financial advisor who was the subject of our financial malpractice series, and you view other financial professionals as competition, you really end up hurting your clients and you really end up missing a lot of opportunities to help your clients more, right? And the irony is you actually end up making more money rather than less. It is true that, yeah, you give up a piece of the pie to somebody else that you're partnering with, but the pie ends up getting exponentially larger because now you can help your clients in so many different ways. And you just can't possibly be an expert in all those different areas. It's just not possible. So thanks, Peter, for coming on the show. Appreciate it. Okay. Earn 750 per day from Home One says your video is profoundly captivating. Success thrives on unwavering dedication. Yeah, I'm assuming this is just a bot or spam. Okay. Miami Dre says this is one of the best Chris Kirkpatrick interviews I've seen. The growth segment was incredible for the life cycle. The insurability is a temporary gift with the transition of how his loved one hasn't gotten that gift back was so sobering. Great job, you guys. AUM being annuitization from the financial institution is gold. Thanks for your comment, DeAndre. I appreciate it. This, I believe, is DeAndre Clayton. So, yeah, he was reiterating some of the themes that Chris and I discussed. The fact that your insurability is an asset. And Chris talked about how he has friends and family who lost their insurability. They're not able to get any kind of whole life insurance anymore, and it can be taken away from you in an instant, in a car accident or something like that. In the case of his wife, it was a car accident, not their fault. They got hit by somebody else, and she lost her insurability. And yeah, and then the assets under management being annuitization. Yeah, that was a great little clip from Chris Kirkpatrick about how the assets under management model, how it allowed the financial institutions to annuitize their income stream. So for many of them prior to that, the way they would make money was via commissions. So they would buy and sell stocks, and each time they bought and sold a stock, they would make a commission off of that, right? Well, that takes work, right? And it's transaction based. They instead want to just collect passive recurring revenue like via an annuity. So what they do instead is say, hey, we'll take your assets under management, give us your money, we'll manage it for you. And then regardless of how much we buy and sell or trade it, we're just going to charge an assets under management fee. So we'll take 1%, right? So if we have $1 million of assets under management, we'll charge you 1%. So we'll make $10,000 for managing that $1 million worth of assets. And now we get that beautiful passive recurring revenue that every business wants. Now, I'm not saying it's good, bad, or indifferent. It's just interesting to see how the industry evolved in that way. So now generally speaking, the financial advisors are not making commissions off of buying and selling stocks. They're just charging a fee for assets under management, right? Which is totally fine. It's just a different model. But it was interesting how Chris talked about it from an annuity standpoint, right? Because if you're in the business like we are, you understand an annuity can be a really powerful income generation tool. So it allowed them to annuitize their business model. So thanks, Chris. Thanks, DeAndre. So this was I think Rocco G74. Looks like this was a comment that was removed. I was responding to this guy. We had a bit of a back and forth, but I guess his comments have been removed since we had this exchange. You can kind of see my responses to him. Okay, here we go. Chris Kirkpatrick commenting on our financial malpractice series says, great video, good happy medium. Too many people saying you should put all of your money into whole life, and too many people saying that you should put no money in whole life. I will say it is impossible to have a fully balanced plan taking all of your wants and needs into consideration without whole life. Yep, thanks for your comment, Chris. Appreciate it. I don't have too much to add to. Unfortunately, most people never even consider whole life insurance, and their financial advisor that they're working with never even presents it to them. If it does come up, it might come up in a very caricatured way as to why it's trash and no one should own it, which is sad because my experience has been anyone who's at least open to the idea, maybe they've never heard of whole life, or maybe they're at least open to the idea. Once you kind of explain to them how it works, pretty much everybody wants it in some form or fashion, in some capacity. Maybe not everyone's going to do the infinite banking concept and get as aggressive with it as I would, but they're still going to want it as a safe foundation, as a store of capital, and so many other things it can do for you. Here's Chris Kirkpatrick commenting again on our financial malpractice series. This is part one, the one that started it all. He says, it is crazy how financial salespeople, I mean advisors, don't look into the long-term needs for people. They just focus on rate of return and jamming money into investment accounts without having a plan for distribution or protection along the way. Great video. Love the abundance mindset. Yep. Thanks for your comment, Chris. I appreciate it. Yeah, I don't see any real planning that comes from. I don't really see any real philosophical framework, right? When they talk about those of them who claim to have a framework, when you look at it, it's really just sales and marketing in disguise. It's not really a framework. Or they're just categorizing the products that their company sells or the products that they can sell. That's not a framework, okay? Just categorizing what you are able to sell. So, yeah, they focus on rate of return. I don't understand why that's so important. Well, I understand why it's important from their perspective, because if you have the investment mantra and you're trying to sell assets under management, then return on investment really is the best sort of sales pitch for that. Just like if you're going to get a mortgage, the mortgage interest rate is sort of the headline number. So, but again, why are we focused on just accumulating assets in an investment account? Why is that how people get rich? I don't think so. I mean, you can do that, but why is that the only way? Why is it the only thing going on? So thanks for your comment, Chris. Appreciate it. John Doe TX says, got it. Thank you, Logan. Appreciate it. Thanks for the comment. Hope you learned something. Peter Nelson comments, part 7. Yes, thank you, Peter. Appreciate it. So I think we ended up doing a 10-part series on that, and then we had a couple of little codas as well. So Mike J9366 says, at 5:05 in the video, how do the life insurance firms feel about being used by people, wealthy or not, as banks? Do they want to end this money management tool? Thanks for your comment, Mike. It's a great question. Short answer is they don't care how you use it, right? When you say use, that's the whole point. They're giving you this product is so you can use it, right? When a real estate investor sells you a house, right, or rents his house to you, right, he wants you to use it and he's profiting from that, right? And he's less concerned with how you're using it. He's more concerned with what you're paying him. So the analogy I use is the life insurance companies are more like the home builders, and we and our clients are more like the real estate investors, right? So the home builder, they're really good at building the house. But once they sell you the house, they really don't care how you use it, right? They're profiting from selling you the house, right? So likewise, life insurance companies are providing us with this phenomenal asset, this phenomenal financial tool of whole life insurance. We decide how we're going to design it and how we're going to use it. That's less of a concern to the insurance companies. Having said that, certainly there are some insurance companies that have expressed concerns about distortions of the infinite banking concept. But from the life insurance company's perspective, it's not like we're doing anything that's not within the contract, right? We're paying premiums into a policy. That policy is designed according within the limitations the life insurance companies give us. And then we're using policy loans, which is a contractually guaranteed right that's in the contract. So we're not doing anything that's really out of bounds from the life insurance company's perspective. It's just a matter of how are we designing and utilizing policy. So from their perspective, it's all positive because now we are selling more policies, right? Because we have discovered some additional ways of using these policies. And I do think the life insurance companies are, again, they don't really care how you use the policy, but I think that they're starting to get more positive on the infinite banking concept as it starts to get more traction because obviously they're selling more policies because of this. And they're seeing some of the top producing agents out there are infinite banking agents. And so the life insurance companies are now starting to realize that the infinite banking concept is a real thing. It's a legitimate strategy. And yes, like every other financial strategy out there, there are people who present it in the wrong way and who misuse it, right? But that's true of every financial strategy, right? So yeah, short answer is they're insurance companies, they're making money from selling these policies. How you use it is less of a concern to them. But thanks for the question. Tampa Retrograde 8951 says, nice presentation, Don. Reverse mortgage not so scary anymore. Thanks for your comment. Appreciate it. Yep. This was with Don Graves talking about the reverse mortgage and how it can be a useful tool for people in retirement. We've had Don on the show more than once where we talked not only about the reverse mortgage, but also a reverse mortgage in conjunction with a whole life insurance policy. Natalie Andrika says, promo SM. I have to confess, I don't know what that means, but thank you for commenting. I appreciate it. And then DeAndre Clayton commenting on financial malpractice part 3 says, bro, I can't believe I found this video on LinkedIn. I'm an IBC practitioner and I teach the concept to almost all of my clients. whenever I hear questions in regards to the IBC that are given to me because of my client's financial advisor, I've been feeling like either they're knowledgeable or it's flat out malpractice. I appreciate your candor here. Yeah, thanks for the comment, DeAndre. It's interesting how everyone pretends to be an expert on the infinite banking concept when in most cases they've never even heard of it before, right? It's just it's the scarcity mentality, right? They view everybody else as as a competitor. They view all new ideas as threats. They view all their financial products as threats to them and their fiefdom. Instead of having the abundance mindset and realizing that we can incorporate these different financial tools and products into our overall strategy. And learning a new concept is probably a good thing. So, yeah, most of them, unfortunately, the vast majority of advisors out there have never heard of the infinite banking concept, or they really don't understand it at all. They have a very superficial understanding of it. They know a few marketing slogans. And in this financial malpractice series, it was absolutely shocking how ignorant, unbelievably ignorant the financial advisor was with regard to whole life insurance. Yet he's speaking dogmatically like he knows what he's talking about when he makes some of the most ridiculous and elementary mistakes. And I think that's fairly common, where a lot of financial professionals like to put up this front as if they know what they're talking about. And for someone like me, you dig one or two questions deep and you can immediately find out this guy doesn't know anything, which is kind of sad. So again, I like to say I'm the little boy who points out that the emperor has no clothes. That's what I do. That's what I do. Thanks for your comment, DeAndre. Appreciate it. Okay. Kevin Bach says, not sure where you got a $3 million spend for long term care. Go with the masses of SNFs, and you're looking at around $4,000 to $5,000 spend on average. I had someone who spent $800,000 over 8 years. In my 34 years, never saw a $3 million requirement. Thanks for your comment. I appreciate it. We were talking about, it was kind of an aside. We were talking about long term care and what it costs. I have spoken with a manager of a long term care facility. I guess it must be one of the nicer ones. I'm not an expert in long term care, and they require you to have, they require to verify that you have $3 million worth of liquid assets before they will admit you, and they have a waiting list. So I can actually point you to this specific one if you wanted to. So yeah, that may be atypical. It may be one of the nicer ones. You can look up and see what it typically costs, but I'm sure what you're saying is accurate. So you notice my humility here. I'm not pretending to be an expert in long-term care. It sounds like this guy knows more about long-term care than I do. It was not an essential point in the video. The point that I was making is the financial advisor was very dismissive of the idea of needing a long-term care plan or trying to pretend that having money in the market is a substitute for a long-term care insurance policy, which is absolutely ridiculous. How much it actually costs is another question. So so $4,000 to $5,000 spend. I'm assuming you mean per month. So $4,000 to $5,000 per month would be the cost. That's You're probably correct, Kevin. I'm not. I think it depends. It depends on geography, depends on what you're doing, and then of course a lot of people. I believe in two-thirds of long-term care insurance claims the insured is still living at home, which is what you want. Generally, you don't want to move them out of their home unless you have to. So there's still spending that happens where maybe they have a nurse come visit them. Maybe they have to make modifications to their house, put in an elevator or things like that. So in my 34 years, never saw a $3 million requirement. Okay. Yeah. So maybe that's unusual, but I have seen it. And you had someone who spent $800,000 over 8 years. Okay. Yeah. You're probably correct, Kevin. Um, Maybe we can have you on the show to talk about long term care. It's not my area of expertise. So I partner with other people when we do. But I do like to point out that, Kevin, I'm sure you'll agree with me. It really is a critical component of retirement planning. You need to have some form of long term care plan in place. That doesn't necessarily mean having a long term care insurance policy, but you need to recognize that if you live long enough, it's likely you'll have some form of long term care slash healthcare needs late in life. And there are very good, efficient ways to prepare for that. And I think you'll agree with me, Kevin, that this financial advisor's ridiculous claim that having investments is a form of long-term care planning is ridiculous. And the fact that he had never even had that conversation with his 75-year-old client is, well, malpractice, quite frankly, right? You need to at least have the conversation with your client. And the client clearly expressed to me concerns about long-term care because he saw his parents go through that, right? So he's a 75-year-old type 2 diabetic. He has a 69-year-old wife who's healthy. Why has the financial advisor not even spoken to him about it, right? But yeah, you're probably right, Kevin, in terms of the cost. 3 million may be very atypical. Maybe that's just one of the more nice facilities. But thank you for your comment. Sounds like you know more about long-term care than me. Appreciate it. Mr. Gus comments and says, makes sense. Thanks for the comment, Mr. Gus. This is on our video, Offense Wins Games, Defense Wins Championships. We talk about that. It is in financial planning, offense wins games, defense wins championships, right? Everybody wants to talk about the offense because that's the part that excites people. But generally speaking, over the long run, it's the defense that really makes the difference. Just like in sports, right? Just like in sports, you don't see too many highlights of defensive plays because they tend to be boring, right? You'll see some defensive highlights where there's a big game breaking play on defense, but you don't see the methodical, disciplined defense they play game in and game out that helps them win games because it's not as exciting on video, but it's absolutely critical to winning over the long run. Same thing is true in finance. Offense wins games, defense wins championships. So SAQer says, love that you are doing this. Great ideas. Thanks for your comment, SAQer. I appreciate it. This is on my Be Your Own Banker video, which may have been my first video, or certainly one of the first videos with Peter Nelson there. So thanks for your comments, everyone. I appreciate it.